Why and what makes the rich get richer? Introduction. A story or example of two people starting with the same resources, but one ends up wealthy while the other struggles. Purpose of the book. Not to shame or glorify, but to uncover the patterns, principles, and mindset shifts that separate the wealthy from the rest. Chapter 1. The Wealth Gap Mystery. Why the rich seem to always pull further ahead. Historical patterns of wealth concentration. Statistics that highlight the gap. Chapter 2. The Power of Compound Growth. Money makes money. Investments, assets, interest. Example of compound interest in action. Why starting early matters more than starting big. Chapter 3. Mindset versus money set. Scarcity mindset versus abundance mindset. How rich people think differently about risk, time, and value. The psychology of wealth creation. Chapter 4. Assets versus liabilities. The secret of buying assets that generate income. Why most people stay poor by collecting liabilities. Case studies. Real estate, stocks, businesses. Chapter 5. Networks and social capital. How connections, mentors, and influence accelerate wealth. Why your network is your net worth. Strategies for building powerful networks. Chapter 6. The Education Gap. Why financial literacy is more powerful than formal education. What rich families teach their kids about money. Self-education as the ultimate wealth builder. Chapter 7. Risk and rewards. Why rich people take calculated risks while others avoid them. Stories of famous entrepreneurs who built empires. How to manage and minimize risks. Chapter 8. Multiple streams of income. Why one paycheck is dangerous. How the rich diversify income sources. Examples. Royalties, investments, businesses, digital assets. Chapter 9. Technology and Wealth Acceleration. How technology has created new wealth opportunities. Cryptocurrencies, digital businesses, automation. Why the rich adapt faster to change. Chapter 10. The Time Factor. How rich people buy time while others sell it. The importance of systems, delegation, and leverage. Why freedom of time equals freedom of wealth. Chapter 11. Discipline, habits, and daily routines. What daily habits separate billionaires from average earners? The consistency principle. Wealth is built, not wished for. Small wins that snowball into big success. Chapter 12. Generational wealth. How the rich pass on wealth, knowledge, and systems. Why many families stay rich across generations. How to build wealth that lasts beyond you. Conclusion. Breaking the cycle. Key lessons summarized. Action steps for the reader. A motivational closing. The rich don't get richer by chance. They do it by choice, and so can you. Why and what makes the rich get richer? Introduction. Why and what makes the rich get richer? Introduction. The puzzle of wealth. Why is it that two people can start life in similar circumstances, similar education, similar jobs, even similar salaries, and yet one ends up financially free while the other struggles to pay bills? This is not just luck, inheritance, or fate. There are clear patterns that explain why the rich seem to keep getting richer. The purpose of this book is not to glorify wealth, nor to shame those who struggle. Instead, it is to uncover the mindsets, habits, strategies, and systems that allow the rich to build lasting wealth. When you understand these patterns, you gain the power to apply them to your own life. As you read, you'll discover that wealth is not just about money. It's about thinking differently, making intentional choices, and playing the long game. The rich are not smarter than the rest of us. They are simply playing by a different set of rules. This book will decode those rules for you. Chapter 1. The Wealth Gap Mystery. If you've ever looked at the world's wealth distribution, you might have noticed something strange. The top 1% of people control more wealth than the bottom 50% combined. Even during economic recessions, times when millions lose jobs, businesses close, and families struggle, the rich somehow find ways to grow richer. Why does this happen? The system favors capital. Most people trade time for money, working jobs, earning salaries, and hoping for promotions. The wealthy, however, understand that money itself can work. Instead of relying only on salaries, they invest in businesses, stocks, real estate, or technologies that generate income even while they sleep. Information asymmetry. The rich often have access to knowledge, networks, and opportunities that average people don't. For instance, they learn about investments before they hit the mainstream. They know tax laws that help them protect and grow wealth. They have mentors, lawyers, and advisors guiding their decisions. The power of scale. When you have wealth, opportunities multiply. A wealthy person who invests $1 million at 10% earns $100,000 in a year without lifting a finger. For someone with only $1,000 to invest, the same 10% return is just $100. The rules are the same, but the scale makes the difference feel enormous. Behavioral patterns. Wealthy individuals often see money as a tool, not just something to spend. They save, invest, and think long-term, while many people prioritize immediate gratification. Over time, these small differences compound into massive wealth gaps. Light bulb case study. During the 2008 financial crisis, while millions lost their homes, billionaire investors like Warren Buffett bought undervalued companies at a discount. 10 years later, those investments multiplied in value, cementing their wealth even further. This raises an important question. What do the rich know that others don't? That's exactly what the rest.
Why and what makes the rich get richer? Chapter 2, The Power of Compound Growth. Albert Einstein once called compound interest the eighth wonder of the world. He went on to say, "He who understands it, earns it, he who doesn't, pays it." So, what exactly is compound growth, and why is it one of the most powerful forces behind the rich getting richer? The magic of compounding. At its simplest, compounding means that your money earns returns, and then those returns themselves start earning returns. Over time, this creates an exponential curve of growth. Imagine two friends. Alex invests $5,000 per year starting at age 25 and stops at age 35, just 10 years. Ben waits until age 35 to start and invests $5,000 every year until age 65, 30 years. Both earn an average annual return of 8%. Surprisingly, by the time they're 65, Alex has about $615,000. Ben has about $540,000. Alex invested less money but started earlier. That's the power of compounding. Time is more valuable than the amount invested. Why the rich benefit more? The wealthy understand this principle deeply. They don't just save money in a bank account, they put it to work in stocks, bonds, real estate, or businesses that compound over decades. Every year, their assets generate returns, which are reinvested to generate even greater returns. Meanwhile, the average person might keep money sitting idle in a savings account, where inflation erodes it. Spend on short-term pleasures instead of investing. Start too late, missing the best years of compounding growth. Compounding beyond money. The rich don't just apply compounding to money. They use it in knowledge. Every book read, every skill learned compounds into greater expertise and opportunities. Relationships, every connection can lead to new doors opening, and over time, these networks compound into powerful influence. Habits, small daily habits, like exercising, journaling, or strategic thinking, build into lifelong advantages. Lesson, compounding rewards patience, discipline, and consistency. The earlier you start, the bigger the payoff. The rich stay richer because they play the long game, while many others seek quick wins. Why and what makes the rich get richer? Chapter 3, Mindset versus Moneyset. One of the greatest differences between the wealthy and the struggling isn't the size of their bank accounts, it's the way they think. Money follows mindset. If you gave $1 million to 10 people today, statistics show that within 10 years, most of them would lose it all, while a few would grow it into something far greater. Why? Because wealth doesn't just require money, it requires the right way of thinking about money. Scarcity versus abundance thinking. Scarcity mindset. People with this mindset believe there's never enough. They fear losing money, cling to what little they have, and often focus on survival instead of growth. Scarcity thinkers avoid risk, delay investing, and often spend money on immediate pleasures rather than future opportunities. Abundance mindset. Wealthy people, on the other hand, view money as abundant and renewable. They believe opportunities are everywhere. They don't hoard, they multiply. They see money as a tool to create more value, more freedom, and more impact. Backhand index pointing right example. While a scarcity-minded person might say, I can't afford this, an abundance-minded person asks, how can I afford this? The second question opens doors to creativity, side hustles, and investments, while the first one shuts down possibilities. Risk perception. Most people fear risk because they only think about what they can lose. The rich think about what they can gain and how to minimize losses through smart strategies. For example, a poor mindset sees investing in stocks as gambling. A wealthy mindset sees it as long-term ownership of valuable companies. Time and value. The rich don't trade time for money forever. They know their time is their most valuable asset. That's why they build systems, businesses, investments, and teams that make money while they sleep. Most people stay stuck because they only know one formula: work, get paid, spend, repeat. The wealthy reprogram this formula into invest, grow assets, earn, continuously reinvest. The psychology of growth. Wealthy people ask different questions. Instead of, what can I buy with this money, they ask, how can this money buy me freedom? Instead of, how much do I earn, they ask, how much do I keep and grow? Instead of, is this risky, they ask, how can I manage and minimize this risk? Light bulb case study. Oprah Winfrey grew up in poverty, but her mindset was rooted in abundance and growth. Instead of seeing her environment as a limit, she saw it as motivation to rise above. Today, she's one of the wealthiest women in the world, not because of luck, but because of her mindset. Practical exercise for readers. Write down your top 5 thoughts about money. Then ask yourself, do these thoughts come from scarcity or abundance? Replace each scarcity-driven thought with an abundance-driven question. Why and what makes the rich get richer? Chapter 4, Assets versus Liabilities. If there's one financial principle that separates the wealthy from everyone else, it's this. Backhand index pointing right: the rich buy assets, while most people buy liabilities, often mistaking one for the other. What are assets? Assets are things that put money into your pocket. They generate income, increase in value, or both. Examples include rental properties that pay monthly rent, stocks that produce dividends and grow in value, businesses that generate profits, intellectual property, books, patents, or digital products that earn royalties.
What are liabilities? Liabilities are things that take money out of your pocket. Many people buy liabilities thinking they are assets. Examples include a new car that loses value the moment you drive it, a big house that costs more in maintenance, taxes, and mortgages than it earns, credit card debt and loans that accumulate interest. The trap. Middle-class families often stretch their finances to buy bigger homes, fancier cars, or expensive gadgets. They look rich, but in reality, their stuff is draining money. The wealthy, however, buy things that pay them back. Case study. Robert Kiyosaki's lesson. In his classic book Rich Dad Poor Dad, Robert Kiyosaki explains how his rich dad taught him that the wealthy focus on acquiring income-producing assets, while the poor and middle-class work for money and spend it on liabilities. This principle is why someone earning $50,000 per year can eventually build wealth, while someone earning $200,000 may still struggle paycheck to paycheck if they only accumulate liabilities. The snowball effect of assets. When you buy assets, they generate income. That income buys more assets. The cycle repeats and wealth multiplies. When you buy liabilities, they generate expenses. You work harder to pay for them. The cycle repeats and debt multiplies. Practical examples. Rich mindset. Instead of buying a luxury car immediately, a wealthy individual invests in an asset like rental property. The income from that property then pays for the car. Poor mindset. Someone else buys the car first, and then works harder to pay off the loan, trapping themselves in debt. Exercise for readers. Make a 2-column list. Assets and liabilities. Write down everything you own. Next to each, mark whether it puts money into your pocket or takes money out. Review. Are you collecting assets or liabilities? Create a goal to add at least one new income-producing asset in the next 12 months. Why and what makes the rich get richer? Chapter 5. Networks and Social Capital. There's an old saying, your network is your net worth. Wealthy people know this isn't just a catchy phrase, it's reality. Money grows in circles of opportunity, and the rich position themselves in the right circles. They don't just build wealth alone, they leverage relationships, partnerships, and networks that multiply their success. The power of connections. Imagine two entrepreneurs starting businesses at the same time. Entrepreneur A works hard but operates alone. They struggle to get clients, make costly mistakes, and move slowly. Entrepreneur B taps into a strong network. They have mentors, partners, and investors. They get introduced to opportunities others never see. 10 years later, Entrepreneur A is still grinding, while Entrepreneur B has scaled and sold their company. The difference? The network effect. Why the rich invest in social capital. Access to information. Wealthy people hear about investments, trends, and opportunities before they hit the news. Information advantage equals financial advantage. Trust and reputation. Deals flow where trust exists. If you're known for reliability, honesty, and results, people bring opportunities to you. Collaboration over competition. The wealthy know partnerships are faster than going solo. They collaborate with like-minded people to expand reach. Case study. Silicon Valley. Why do so many billion-dollar tech companies come from one small region in California? It's not just luck, it's the network. Entrepreneurs, investors, and innovators live in the same ecosystem, constantly sharing ideas, funding projects, and supporting each other. How to build a wealth-building network. Seek mentors. Rich people often have mentors guiding them. Find someone 10 years ahead of you. Add value first. Don't ask, what can I get? Instead ask, what can I give? Wealthy networks reward people who bring value. Expand circles. Attend industry events, mastermind groups, and communities where ambitious people gather. Leverage technology. LinkedIn, online communities, and professional groups give you global reach. The hidden currency. Social capital. Wealth isn't just measured in dollars, it's measured in trust, influence, and reputation. Social capital often opens doors that money alone cannot. Light bulb example. A billionaire can pick up the phone and call another billionaire to close a deal. That level of access comes from years of relationship building, not just money. Exercise for readers. Write down 5 people in your current circle who lift you higher, and 5 who drain your energy. Make a plan to spend more time with those who inspire and challenge you. Choose one event, community, or group this month to expand your network. Reach out to one potential mentor or partner this week with a message of value. Up next will be Chapter 6, The Education Gap, where we'll uncover why financial literacy, not just school education, plays a major role in keeping the rich richer. Why and what makes the rich get richer? Chapter 6, The Education Gap. When most people hear the word education, they think of schools, universities, and degrees. But here's the truth. Formal education may earn you a living, but self-education can earn you a fortune. This is where the rich often gain a decisive edge. They don't stop learning after graduation. Instead, they focus on financial literacy, the type of education that teaches how money works, how wealth is built, and how opportunities are seized. Why formal education isn't enough. Schools are designed to create employees, not entrepreneurs. Students are taught to follow rules, to memorize and repeat information, to aim for safe jobs and stable paychecks. But what schools rarely teach is how to invest, how to manage debt, how to build a business, how to create passive income. That's why many graduates, even doctors and lawyers with high incomes, still struggle with money. They were trained to earn money, but not to grow or protect it. What rich families teach their kids. Wealthy families raise their children with different conversations. Dinner table talks about investments, businesses, and opportunities. Encouraging kids to think like owners, not just workers. Introducing them early to mentors, advisors, and financial tools. By the time a wealthy child is 20, they may already understand stocks, real estate, or entrepreneurship, while others are just figuring out how credit cards work. Self-education as the great equalizer. Here's the good news. Anyone can close this gap through self-education. The rich get richer because they invest heavily in learning. They read books on money, investing, and psychology. Attend seminars, workshops, and mastermind groups. Hire coaches and mentors. Study market trends and financial systems. Light bulb case study. Warren Buffett. Buffett, one of the world's richest men, spends about 80% of his day reading. Early in his career, he read 600-1,000 pages daily. His fortune didn't come just from money, it came from a relentless appetite for knowledge. The cost of ignorance. Ignorance is expensive. Many people lose money not because of bad luck, but because of lack of knowledge, signing unfair contracts, falling into debt traps, missing out on investments because they didn't understand them. The rich pay for advice, lawyers and accountants to protect their wealth. The poor avoid paying for advice, and often pay far more through mistakes. Practical exercise for readers. List 3 books on money, investing, or business you'll read this year. Write down 1 new financial skill you'll commit to learning in the next 90 days, e.g., stock investing, real estate, or online business. Find a mentor or online course that can accelerate your financial literacy. Next will be Chapter 7, Risk and Rewards, where we'll see why the rich embrace calculated risks while others fear them. Why and what makes the rich get richer. Chapter 7, Risk and Rewards. If you study the lives of the wealthy, one thing stands out: they don't avoid risk, they manage it. The poor see risk as danger. The rich see risk as opportunity. Why most people fear risk. The average person has been taught to play it safe, get a secure job. Don't take chances. Better safe than sorry. This mindset leads to comfort zones, but comfort zones rarely produce wealth. Fear of risk keeps people locked in the same patterns, living paycheck to paycheck. How the wealthy approach risk. The rich don't blindly jump into danger. They take calculated risks. That means they research opportunities deeply, surround themselves with experts, only risk what they can afford to lose. Balance risks with rewards. Instead of asking, what if it goes wrong? They ask, what if it goes right? Case study, Elon Musk. When Musk sold his first company, Zip2, he made $22 million. Instead of playing it safe, he reinvested almost everything into PayPal, Tesla, and SpaceX. At times, he was close to bankruptcy. Today, he's one of the richest men alive. His willingness to take calculated risks changed industries. The hidden risk of playing it safe. Most people think avoiding risk keeps them safe, but the truth is, playing it safe often carries the biggest risk of all. Inflation eats away at savings. Jobs disappear with layoffs or automation. Missed opportunities never come back. By avoiding risk, many unknowingly guarantee financial struggle. How to manage risk like the rich. Diversify. Don't put all your money in one place. The wealthy spread investments across industries and asset classes. Educate yourself. The more you know, the lower the risk. Start small. Test ideas with small investments before scaling up. Have a safety net. Never risk money you can't afford to lose. Risk versus reward formula. The rich weigh every decision with this question: is the potential reward worth the risk? If yes, they act boldly. If no, they walk away. Practical exercise for readers. Write down 3 risks you've been avoiding in your financial life. For each, ask, what is the worst case scenario? What is the best case scenario? Choose one calculated risk to take in the next 30 days, e.g., starting a side business, investing in a course, or putting money into an asset. Next, I'll move into Chapter 8. Multiple streams of income. One of the biggest reasons the rich stay richer. Why and what makes the rich get richer. Chapter 8. Multiple streams of income. Have you ever noticed that the truly wealthy rarely rely on just one source of money? Unlike most people who depend solely on their salaries, the rich design their financial lives like rivers feeding into one ocean, multiple streams flowing into their wealth. The danger of a single paycheck. For most, income comes from a single paycheck. If that job disappears due to layoffs, illness, or automation, financial security vanishes instantly. This is financial fragility. The wealthy understand that depending on only one source of income is like building a house on one pillar. Eventually, it collapses. How the rich build multiple streams. Businesses. Owning or investing in companies. Real estate. Rental income, appreciation, commercial properties. Investments. Stocks, bonds, dividends, index funds. Royalties and licensing. Books, music, intellectual property, patents. Digital income. Online courses, apps, YouTube, affiliate marketing. Partnerships. Collaborations that produce passive returns. Case study. Shaquille O'Neal. After retiring from basketball, Shaq could have lived comfortably off his NBA salary. Instead, he built streams of income by investing in franchises, like Papa John's, Five Guys, and Krispy Kreme, technology companies, and media. Today, his net worth is hundreds of millions, not just from basketball, but from diversified income streams. The compounding effect of multiple streams. When one stream is slow, another flows stronger. Over time, these streams provide stability, no single point of failure. Growth. Each stream reinvests into building more streams. Freedom. Less reliance on trading time for money. Why the average person struggles. Most people focus only on their job. They wait until later to start a side hustle, invest, or learn new skills. But by the time they realize it, they've lost decades of potential compounding. Meanwhile, the rich are constantly planting seeds in new areas. Some grow, some fail, but the winners build lasting wealth. Steps to build multiple streams. Start with one strong foundation, job or business. Save and invest a portion into assets that generate cash flow. Create at least one side stream that can grow passively, like an online business or rental property. Over time, aim for 3 to 7 streams of income. Light bulb. Remember, millionaires typically have at least 7 income streams. Practical exercise for readers. Write down your current income streams. Most people only have one. Brainstorm 3 possible new income streams you can create in the next 2 to 3 years. Choose one to start building this month, whether it's investing, freelancing, real estate research, or a digital side business. Next, I'll write Chapter 9, Technology and Wealth Acceleration, showing how the rich use innovation to widen the gap. Why and what makes the rich get richer? Chapter 9, Technology and Wealth Acceleration. In today's world, technology isn't just convenient, it's a wealth accelerator. The rich don't just adopt technology, they leverage it to create opportunities, scale businesses, and increase returns exponentially. Why technology benefits the wealthy? Access to information. The wealthy can analyze markets, spot trends, and make informed decisions faster than the average person. Automation of income. Technology allows money to work without constant effort. Think online businesses, automated investing, and apps that generate passive income. Global reach. Digital platforms remove geographical limits. A business in New York can sell products to someone in Tokyo instantly. Case study. Jeff Bezos. When Jeff Bezos started Amazon in 1994, he saw the internet as a tool to reach millions of customers without building a physical retail empire. Today, Amazon dominates global e-commerce, and Bezos's wealth is a direct result of leveraging technology early. Other examples. Elon Musk leveraged technology to disrupt multiple industries: electric cars, Tesla, space travel, SpaceX, and AI, Neuralink. Oprah Winfrey used TV, media, and digital platforms to multiply her influence and income. Warren Buffett, though traditional in investing, he uses technology for research, market analysis, and scaling his investments. Why many people miss out? Most people fear new technology, thinking it's too complicated or risky. The rich, however, study it, adopt it, and invest early. They understand that innovation creates new opportunities faster than traditional methods. How to leverage technology for wealth. Invest in tech stocks or startups. Early adoption can yield huge returns. Start a digital business, e-commerce, online courses, apps, or content creation. Automate processes. Save time and money by using technology for efficiency. Stay informed. Follow trends in AI, blockchain, and automation. Light bulb lesson. Technology amplifies everything: income, learning, networking, and influence. The rich get richer because they are early adopters and innovators. Practical exercise for readers. List 3 technologies you can use to generate income or improve efficiency this year. Identify one emerging trend: AI, e-commerce, digital marketing, crypto, etc., and research it for at least 1 hour per week. Plan one small step this month to leverage technology for wealth growth, e.g., launch a digital side project, automate savings, or learn a tech skill. Why and what makes the rich get richer? Chapter 10. The time factor. One of the greatest advantages the wealthy have isn't money, it's time. While most people trade hours for dollars, the rich buy time, and time, when used wisely, compounds just like money. Why time is the ultimate asset? Time allows for learning, investing, networking, and creating new income streams. Money can be replaced, lost time cannot. By freeing up their time, the rich can focus on high-value activities that produce exponential returns. How the rich buy time. Delegation. They hire experts and assistants to handle tasks that others struggle to manage themselves. Automation. Technology replaces repetitive work. Online businesses, investment tools, and systems generate income with minimal active effort. Prioritization. They focus only on activities that add the most value. Low-value tasks are outsourced or eliminated. Case study: Richard Branson. Richard Branson, founder of the Virgin Group, owns over 60 companies. Yet he spends much of his time enjoying life and pursuing passions. How? By delegating operations to trusted managers and systems. Branson's wealth grows while he invests time in high-impact opportunities and experiences. The danger of trading time for money: most people work jobs where income stops if they stop working. This creates a time for money trap, which limits growth and prevents wealth accumulation. Strategies to multiply time: create passive income. Let assets work while you focus on new ventures. Use leverage. Money, technology, and people can multiply your time. Plan for efficiency. Eliminate distractions and focus on high-value tasks. Light bulb lesson: freedom of time equals freedom of wealth. The rich get richer because they prioritize time over temporary comfort. Practical exercise for readers: track how you spend your time for 1 week. Identify 3 low-value tasks you can delegate, automate, or eliminate. Allocate that freed-up time to activities that grow your wealth or skills. Chapter takeaways: time is a more valuable asset than money. Wealth grows faster when you leverage others and technology. Delegation, automation, and prioritization free you to focus on high-impact opportunities. Why and what makes the rich get richer? Chapter 11. Discipline, habits, and daily routines. Wealth isn't just built through big decisions, it's built through small, consistent daily actions. The rich know that discipline and habits compound over time, just like money. The power of daily habits. Wealthy people plan their day around high-impact activities. They avoid distractions and focus on tasks that multiply income or knowledge. Consistency beats intensity. Small, repeated actions yield extraordinary results. Key wealth-building habits: reading and learning daily. Warren Buffett reads hundreds of pages daily. Elon Musk consumes vast amounts of technical knowledge. Financial tracking. Wealthy individuals monitor spending, savings, and investments regularly. Goal setting and review. Daily, weekly, and monthly planning keeps them on track. Networking and mentorship. They invest time consistently in relationships that grow their opportunities. Health and energy. Exercise, diet, and sleep are prioritized because energy fuels productivity. Case study: Oprah Winfrey. Oprah begins her day with meditation, reading, and exercise. She journals daily to reflect and set intentions. These small habits build mental clarity, resilience, and focus, tools she used to grow her empire. Why most people fail? Many people rely on willpower and luck, rather than systems. Without habits and routines, success becomes erratic and inconsistent. Strategies to build discipline: start small, build one habit at a time. Use routines to automate good decisions. Track progress and celebrate milestones. Surround yourself with disciplined, high-performing people. Weekly action plan for readers. Morning routine. Dedicate 30 to 60 minutes daily to reading, planning, and reflection. Financial review. Track all income, expenses, and investments weekly. Networking. Reach out to at least one mentor, peer, or potential partner per week. Skill building. Spend 2 to 3 hours per week learning a new skill that can grow income. Health and energy. Exercise at least 3 times a week and prioritize quality sleep. Chapter takeaways. Wealth grows from consistent habits, not sporadic effort. Daily routines and discipline compound over time. Prioritizing learning, relationships, and health accelerates wealth building. Why and what makes the rich get richer? Chapter 12. Generational wealth. True wealth isn't just about accumulating money. It's about preserving and growing it for future generations. The rich understand that building wealth for one lifetime is only the beginning. Why many people don't leave a legacy? They spend all their earnings instead of investing. They fail to teach their children financial literacy. They lack systems to protect and grow wealth over time. Without planning, wealth often disappears within a generation. Studies show that 70% of wealthy families lose their fortunes by the second generation, and 90% by the third. How the rich build generational wealth. Financial education for children. Teaching kids about money, investments, and entrepreneurship from an early age. Asset protection. Using trusts, legal entities, and smart estate planning to preserve wealth. Multiple income streams. diversifying assets to ensure long-term stability, philanthropy and values. Many wealthy families instill responsibility and purpose alongside money. Case study: the Rockefeller family. John D. Rockefeller, America's first billionaire, built massive wealth in the oil industry. Today, more than 100 years later, the Rockefeller family continues to maintain significant wealth, not just through inheritance but through education, diversification, and strategic planning. Building your own legacy. Start teaching your children about money early. Establish financial systems that protect and grow assets. Focus on investments that compound over decades. Encourage entrepreneurship, innovation, and smart risk-taking in your family. Practical, legacy building, tips for readers. Family financial education. Dedicate 1 hour per week to teach family members about money and investing. Create a will or trust. Ensure assets are protected and distributed according to your plan. Invest for generations. Consider long-term investments like real estate, stocks, or businesses that can last decades. Document wealth strategies. Write down lessons, strategies, and principles you want future generations to follow. Mentorship. Guide your children, nieces, nephews, or young entrepreneurs in your circle with your experience. Chapter takeaways. Generational wealth requires planning, education, and disciplined asset management. Teaching financial literacy is as important as accumulating money. Wealth that lasts beyond a lifetime is built through systems, values, and long-term vision. Conclusion. Breaking the cycle. The rich don't get richer by accident, they do it through strategic thinking and financial literacy. Mindset shifts and disciplined habits. Leveraging assets, networks, time, and technology. Planning for long-term growth and generational impact. The lessons in this book are actionable. They are not secrets reserved for billionaires. They are principles anyone can apply. By starting today, committing to learning, building assets, and taking calculated risks, you too can break the cycle and grow lasting wealth. Light bulb final takeaway. Wealth is a choice, mindset, and system. The sooner you adopt these principles, the sooner you can join the ranks of those who get richer, not just once, but consistently over a lifetime.